I'm Jessica Mitchell for IB Times TV, reporting from the floor of the New York Stock Exchange, and joining me today is Peter Cardillo of Rockwell Global Capital. Now, you were one of the few people that predicted that the Fed would end up not tapering. How much longer do you think the QE program can continue until we start seeing an issue with inflation?
Well, I don't think it's going to be an issue with inflation, but I do believe that they probably will begin tapering in December. I've been saying that all along, and I'm not changing my mind as far as that is concerned. And simply because of the fact I think they need to get a little bit more data regarding the labor market. And of course, consumer spending, that's going to be key. And then of course, there's that battle of the debt ceiling that's going to increase over the next several weeks, and so the Fed is not taking any chances, and I don't think they want to take any chances. There's one thing the Fed does not want to do, and that is to disturb the markets, and they did that. They did that during the summer when they began talking back in June, when they began talking about tapering, and then all of a sudden, look what happened to the bond market. We had yields double from the low end of the trading range, and certainly they don't want to do that. We had a pullback in the stock market. The one thing the Fed does not want to do, and that is to dampen assets at this point, simply because of the fact that would have a negative psychological impact. So you can't begin to change monetary policy without disturbing the stock market. And I think they're going to do exactly what they've been doing. Look what happened today. We already heard from one of the Fed speakers, Fed Bullard, who basically said he thinks that maybe tapering can happen in October. Later in the day, we'll be hearing from Fed George. She's been a hawk about this, so there's a good possibility she's going to emphasize that tapering is getting closer, or possibly even in October. I don't think that's going to be the case. But in any event, we're going to get this, jaw bulking back and forth from the Fed members, and of course the debt ceiling is going to make continuing headlines over the next several weeks, and that could be a little bit of a dampening factor for the market. Not because investors really believe that, not because the market believes that. We all know it's politics as usual. At the end, America will pay its bills, but it's just a technical, I guess, factor, and a psychological factor, if you want to say that. With the markets at record highs, a little bit of a pullback. It needs the catalyst. So the catalyst is going to be debt ceiling factor, and then, of course, we'll wait for the earnings season.
Now, when Fed officials hint at, we might scale back in October or even December, what data are they specifically talking about? And are they also including the fact that we are getting the final revision of second quarter GDP next week?
The final revision of the gross domestic product for the second quarter is probably going to be up by 0.1%. That's what I'm looking for, 2.6%. That's not going to be a factor. What they're really looking at is the job numbers. And unless we see a real turnaround real quick, that's going to be a major factor for them. And above all, consumer spending. And by the way, we'll get personal spending next Friday, and I think it's going to be on the weak side, probably up about 0.1%. So, for the next month or two, they're going to continue to analyze consumer spending and the big factor, the labor market.
Now, in our last interview, we talked about the housing market recovery, and you mentioned that interest rates may have already begun to start impacting housing. Do you think the Fed took this into consideration, and that's why they decided not yet to start tapering now?
No question about it. If you look at yesterday's housing data, certainly it was a number that suggests otherwise. But if you track the weekly mortgage applications, they've been south of the border for the past 5 to 6 weeks. And that, I think, is what the Fed is really worrying about. Not so much that the housing market is ready to turn back into negative performance. No, that's not the worry. The worry is, will the market flatten out? And that's a key asset for not only for the performance of economic activity, but for the stock market as well.
Now, next week on the economic calendar, we are going to get durable goods orders, and we're also getting a lot of housing data, such as the Housing Price Index, new home sales, and pending home sales. What do you think we really should be focusing on for next week?
I think what we should really be focusing on, consumers' confidence, personal income, and personal spending. These are the three key reports of next week. These are the numbers that the Fed is going to take a hard look at. Remember, the housing numbers probably are going to be somewhat a little bit softer, but not an indication that there's serious problems just yet. So I think it's the confidence, spending, and how much earnings power does the consumer have after he pays taxes.
And finally, today is quadruple witching. Do you think we're going to see some high volatility trading today?
Probably towards the end of the day. Right now, the market is basically slipping in and out of the plus and minus column, which is quite common for an expiration day. And so I think, at the end of the day, we could probably see volume swell, but it's not significant whatever happens today.
Peter, as always, it's great to have your insight. Thank you so much for joining me. That's Peter Cardillo of Rockwell Global Capital, and I'm Jessica Minton for IB Times TV.